Hello, everyone. Welcome to the webinar today. So glad to have you with us. My name is Alexandra Alvarado, and I'm the Director of Marketing and Education here at the American Apartment Owners Association. Today, we're going to be talking about DSTs and specifically how investors are using DSTs to replace debt in a 1031 exchange. I know most of you by now have probably heard about 1031 exchanges, but this is definitely a strategy that you can use that you may not know all the details about. So we brought with us Matt McFarland, who is our expert here on DSTs. He is the Senior Vice President at K Properties and Investments, and he works out of K Properties headquarters in Los Angeles, so close to me and our headquarters here at AAOA. He helps clients with their 1031 exchanges and direct investments. And prior to joining K Properties, Matt worked at a national commercial real estate tenant representation firm where he was involved in representing commercial tenants in their leasing of commercial office, industrial, and flex space. And then since joining K Properties, Matt has participated in more than 2,000 transactions and over $15 billion worth of real estate. He's known for his in-depth knowledge of 1031 exchange strategies and the DST investment structure. And is especially adept at educating, which is why we have him here today. He's a graduate of UCLA, which is great. So we are just so thrilled to have you, Matt. You really are always bringing a ton of information to our members and presenting it so nicely. So we're going to go through that with you. But before we do that, I do want to emphasize to everyone hopping in today, we are recording it. We are going to be sending you the recording tomorrow with the slides and Matt's contact and K Properties contact information. So you'll be able to reach out if you have any questions that we're not able to answer, maybe on the webinar. They'll definitely be getting back to you. And we'll also be sending you the invite to the next webinar as well in that email. So keep an eye out for that. We'll send that out probably either by end of day tomorrow at the latest, but possibly even today. So keep an eye out for that. Also, if you have questions, we are going to have time here at the end of the presentation for Q&A. So put your questions in the Q&A box, not the chat. That helps us to kind of keep track of the questions a little bit better. So Q&A box is preferred for questions, and then chat is really more so for comments or just to say hello, which you're welcome to do if you want to say hello in the chat. We'd love to see where you're coming from. Go ahead and put that in the chat as we start our presentation. I'm going to go ahead and hand this off to you, Matt. Thank you so much for joining and for doing this presentation for our group. I know you're super busy, so this is really great to have you.
Much, Alexandra. Yeah, we really appreciate the opportunity, and I just want to say thank you to everyone who has tuned in today. We hope that you find this next 45 minutes to an hour really informative. I think that's one of the aspects that we really pride ourselves on over at K Properties is just providing really great education. The DST is a great structure. We're really passionate about it. But before we get into any of the investment particulars, I think it's really important to understand and educate investors on the structure so they can make the most informed decision is if the DST is a good fit for them or not. So we hope that the contents herein, provide additional context and clarity, specifically to a topic that a lot of investors struggle with, specifically as it relates to DSTs and just 1031 exchanges in general, is this topic of replacing debt. So we're gonna walk through the specific IRS kind of rules and regulations behind this. But before I get to that, I want to give just a little bit of context and clarity as to who we are at K Properties and what we do specifically, and maybe a little bit more context on the DST first. Then we'll talk about the 1031 and IRS regulation, and then we'll go through some specific examples of how debt can be utilized in the context of a couple different exchanges. So I'm just going to jump right in here and first talk about kind of the DSTs and K properties. So K properties, we're a national DST advisory platform. So our role is to educate and advise, right? We've had the privilege of working with thousands of investors over nearly the last 2 decades. Um, Complete 1031 exchanges into DSTs. A big part of our role, like I talked about, is the educational aspect. And then further down the line, that's when the advisory kind of part of it would come into play. And really our typical investor is someone who is looking to distance themselves from any type of active management, right? It's investors who have owned their real estate for a long period of time. They've invested a lot of their resources and their energy into their rental portfolio over many decades. In certain cases, they've done very well. They've created a lot of equity. They have a lot of appreciation build up, and they're getting to a point of their lives where they want to transition to more of a retirement based experience, right? They want to spend more time with their children, their grandkids. They want to travel, invest time in other hobbies, even other businesses or endeavors. And managing their properties can be a big inhibitor of that, right? And so they look at what they've created and all this appreciation, all this gain, and they approach a sale and the 1031 exchange specifically as an avenue for them to defer all the taxes associated with the sale. But more specifically, within the confines of a 1031 exchange, they're looking at a DST to be the most passive kind of turnkey option for a kind of a passive investor type, right? So this could be a really good tool or strategy for someone that is specifically looking to get to a different kind of stage of their life, kind of transition actively managed real estate to very passively managed real estate and do it all the while through a 1031 exchange and be able to fully defer all of the capital gains, recapture all the taxes that would ordinarily be due upon sale. So at K Properties, we've had the privilege of helping investors purchase nearly 10,000 interests in DSTs over the last nearly 20 years. And this is something that we have taken a very narrow focus on. We've chosen to specialize specifically in the DSTs and really kind of build out and create a team around that for two reasons. And the main reason is we feel that that is the way that we can best serve our investors is by being very active and present in this ever-changing, landscape, which is the real estate world, and then kind of our specific landscape, the DST environment. But also more so just from a service-based model. We really pride ourselves on of serving our investors and being available for them and present and taking the time to walk through and understand their situation and apply that understanding to and our understanding of the DST space and coming up with kind of a curated target set of solutions. So across our team, we have over 340 years of real estate experience. I mentioned we've worked with thousands of investors, nearly 10,000 DST investments, over $39 billion worth of DST real estate. And our platform, which if you haven't, signed up or ever kind of inquired with us, you can go onto our website at kpi1031.com, and there you can actually see all of the different DST investments that we have available. from over 25 different DST sponsor companies, which are the groups that are kind of structuring these investments and managing them, as well as tremendous educational resources as well. So that's just a little bit about us. I already touched on a little bit of this already with respect to the DST structure specifically being something that investors are targeting specifically to eliminate kind of the day-to-day headaches that come with property management. I'm sure you have heard about the terrible T's, the toilets, tenants, and trash. I mentioned a little bit already on the diversification aspect, but just to elaborate on that a little bit further, the typical minimums that you see in a DST are as low as $100,000, sometimes even less. So our typical 1031 exchange investor, they're selling a property that is worth much more than $100,000, especially here in Southern California. And so a big part of this approach is not only to help transition the investor to a passive investment experience, but also to create a balanced, defensive, diversified portfolio that is achieved by taking whatever the 1031 exchange proceeds are and selectively spreading those out across multiple different types of investments with multiple different companies, different locations, different debt structures, so on and so forth, to build almost like a balanced, defensive, almost mutual funds like approach to this tax advantaged investment real estate. So diversification is a key attribute and definitely a benefit that many of our investors take full advantage of. And then with respect to the financing, which we're gonna speak mostly about today, is the financing that a number of these investments have, or the ones that do carry financing, is typically going to be long term. It's usually 10-year debt structures that you see in the DST space, non-recourse financing, which means that the individual investor does not have any recourse in a foreclosure type situation where they're going to be liable for anything beyond the amount invested in that specific property. And then even beyond that, the financing is pre-structured. It's structured into the investment, whereby the individual investor does not have to go out and individually qualify for the loan. They merely step in and assume their portion of the in-place financing. Once again, we're going to get way more into this a little bit later, so I'm going to just kind of keep moving on here. But in addition to that, access to a higher caliber type of real estate, right? These are typically what we describe as institutional caliber real estate deals. So from a price point perspective, you're looking at anywhere from 10 to 15 million on the very low end to 100, 200, 500 million in certain cases, right? So these are larger kind of institutional caliber real estate deals that are made available to a high net worth individual investor because they're coming in and buying a piece of that much larger property, right? They're owning an interest in the trust that actually holds deed to this much larger property, and their interest is owned alongside a group of other investors that collectively own the property together. And then the last thing here on the screen is the ability to close in a 3 to 5 business day span. This is a huge value add for 1031 exchange investors who are wanting a certainty of close, right? Specifically with the 45-day identification period, that poses a bit of a challenge for a traditional, 1031 exchange investor, because you really have 6 weeks, 45 days from when you close on your relinquished property to identify the properties you intend to acquire as part of the 1031 exchange effort. And as you know, anyone that's purchased a piece of real estate, there's a lot of complication that typically comes with that, right? Not only do you have to find the property, in an area that you like, but at a value that you like, you have to deal with the lender, you have to, deal with the brokers. Like there's all these moving parts, and you have to be confident that what you're listing on your identification sheet with the qualified intermediary is going to stick, right? And if it doesn't stick, then you're in a taxable situation, right? Of not being able to close on what you've identified. So the DSTs really help mitigate a lot of that closing risk by being able to close on the DSTs in such a short period of time. And the reason why an investor is able to close on such a short period of time is because the property has already been sourced and acquired, right? It's already been closed on. All the due diligence has been done. It's ready to go. And once the investor closes on their piece, that portion of their 1031 exchange is complete. So definitely a value add for investors to consider. So now we'll move into talking about the actual 1031 exchange requirements. So number one, an investor must use a qualified intermediary. If you don't know what a qualified intermediary is, think of a qualified intermediary as another escrow, right? They're set up to receive the proceeds that are generated from the sale and administer the exchange forward, right? So this qualified intermediary company, they're going to be the ones that a 1031 exchange investor identifies their properties with. They're going to be the ones that send the wire transfer out to the property that's being acquired, or to the escrow or to the DST, depending on kind of which direction that an investor goes. But it's really, really important that the investor does not come into direct possession with the funds that are generated from a sale. So that's foundational to any 1031 exchange investment is utilizing a qualified intermediary. Number two and number three here on the screen have to do with value. And this is where some people can get a little bit confused. So number two, an investor has to reinvest 100% of the net sales proceeds that were generated from the sale. So what do we mean by net sales proceeds? Here we mean net equity available or generated from the sale, right? So if an investor sells a property for $1 million and they pay off a loan for 500,000 and they have $500,000 of cash left over, what this is saying is $500,000, that full amount needs to be reinvested. And then if we shift over to number three on the screen, the investor must purchase an equal or greater value of replacement properties, right? So number two has to do with the equity or the cash value. Number three has to do with the total value of what was sold. So going back to my example, the $1 million sale, 500,000 cash, $500,000 loan, the investor must invest 500,000, the full 500,000, and they must purchase something for $1 million or more to completely defer their taxes and not have any type of taxable situation. Now, investors can do a partial exchange, right? There can be a situation where, let's just say, an investor wanted to pull some money out and get a little bit of liquidity. That is totally fine, but the investor would be subject to boot, or there would be a proportional tax associated with any amount of cash that is withdrawn from the closing. So we'll touch more specifically on the debt piece and how that interacts with DSTs, but that's really important for investors to get their head around. Reinvest all the cash, purchase equal or greater value. right? Those are the foundational value attributes to a 1031 exchange. And then number four is the 45-day identification window. 45 days from when the property closes, the relinquished property closes, an investor must submit a list of what they intend to acquire or identify with their qualified intermediary. And then beyond that, an investor has 180 days from the closing of the relinquished property to actually close on their replacement properties. The 180 days is usually not an issue for people. It's usually the 45-day identification period that becomes a little bit more challenging. So I already talked about this, but any cash or debt that's not reinvested is known as boot and is subject to capital gains tax, right? So it is possible you can come up a little bit short in the 1031 exchange, but there would be a subjugation to taxation in that situation. Um, so kind of shifting gears here a little bit to focus on the DSTs in particular. So talking about, debt replacement in a traditional sense, an investor typically, when they sell a property that has a mortgage against it, that mortgage is paid off at closing, right? The cash proceeds get sent to the qualified intermediary. And let's just say they go back out into the market and they buy another hands-on, replacement property. They would contribute, all their cash and they would go back to the bank and get another loan, to replace the value of loan proceeds that were retired at closing on their relinquished property, right? So that's the traditional sense. Getting back with the lender, qualifying for the loan, getting the loan, buying the property for equal or greater value. In the DST approach, it's a lot easier for investors to replace debt, because the debt is pre-structured into the deal and it's non-recourse. So we use this terminology called prearranged debt. I've used the term pre-structured. So what we mean by this is the sponsor company, the DST asset management company, that has sourced the deal and has structured the deal. In the process of acquiring that property, they've already gone to a lender and they've already qualified for the loan. They've used those loan proceeds to acquire the property, and they've signed all the carve outs. They've guaranteed the debt on the institutional level, right, on the sponsor level, and they're putting out, this DST in the marketplace, whereby an investor can come in and automatically assume the debt that they've already set up or structured, into the offering. So the reason why this is important is it allows the investor to not have to qualify, for the loan, or secure new financing, undergo personal credit checks, all the financial documentation that is required to go to the lender, in this case. So it allows investors to completely sidestep that whole part of the process. And then on top of that, kind of gain access to kind of a higher quality, kind of institutional type of financing. So a lot of these, leveraged multifamily properties, these are Fannie Mae, Freddie Mac, type loans, that typically can be structured at a more competitive interest rate due to the relationships that these companies have with, these preferred lenders. So definitely some benefits there, but specifically in this slide, not having to source or secure new financing. That financing is already sourced and structured for the investor. We touched on the non-recourse aspect. So non-recourse loan is a type of loan that is secured by collateral, but it limits the lender's recourse to that collateral if the borrower defaults. So in other words, the lender can't pursue other assets of the borrower. So they can't pursue other assets of the DST investors in this example, if the borrower defaults in any way on the non on so there's an example at the bottom here. If a borrower defaults on a non-recourse apartment loan, the lender can only foreclose on the apartment and cannot take any other legal action to collect the debt, right? So from a maximum exposure perspective, the DST investor's maximum exposure is the original equity or cash value they contributed to that specific investment effort, right? And a lot of investors, there's a lot of peace of mind that comes with that. And specifically through diversifying too, they're limiting their exposure to, these types of events taking place. So that's a key, attribute. In terms of the actual types of debt that you see in the DST landscape, there's your traditional DST leverage, which we identify here as being anywhere from 30 to 55%. LTV is short for loan to value. So that's the value of the loan divided into the total value of the investment offering. So 30 to 55%, this would be considered very conservative, type financing in the real estate investment world. A lot of people are maybe used to putting 25% down or 20% down or even less. Here, we're talking about, 50 to 55% is kind of on the higher end in terms of the debt to total value ratio. So definitely more conservative. There's another kind of highly leveraged option that's called the zero coupon strategy. We'll touch on this in a little bit more detail a few slides down. But these can be, 70 to 90% loan to value. So these are specifically oriented for investors that either need to replace a very significant amount of debt or they want to use these, to replace debt in their exchange kind of requirement by contributing, excuse me, a minimal amount of equity, right? And when we'll go through some specific examples as what this looks like in just a minute. And then the third is there are many DSTs that are 100% debt free. So there's no financing whatsoever. It's 100% owned by investor equity. This is always our recommendation for someone that is selling a property free and clear that does not have a debt replacement requirement. So we're always going to encourage those investors to stay debt free. So those are the three kind of basic types. Okay, so we're gonna go into a couple different examples of different exchanges and try to put words to numbers a little bit more and show a couple different strategies that investors can employ to hopefully drive home some of the concepts that we're talking about. So example number one, um, let's say you sell a $1 million property with a $500,000 loan, right? So let's first talk about the 1031 exchange requirements. The investor must reinvest $500,000 of equity from the sale, and they must apply or qualify for a new loan to replace a loan value of 500,000. Okay. The result is the investor has now replaced the $1 million value requirement and they've completely deferred, their taxes, right, associated with the exchange. So kind of moving back into the traditional loan to value DSTs, this is where you see the highest percentage of leveraged DST offerings. These are kind of the more traditional leverage. These are DSTs that they're structured with anywhere from 30 to 55% loan to value. These properties are pretty much always going to be, stabilized. They're usually newer properties. They're usually producing, immediate cash flow from the very beginning. So an example of this is a property, on the screen, there's this apartment property. Let's say there's a 50% loan against it, and let's say it's worth $50 million. So 25 million of the 50 would be the loan that is structured. 25 million would be the investor equity or cash that comes in, to participate in something like this. If you take a look at our property menu or our listings, you'll see kind of a range of different property types with different leverage ratios, et cetera. But this traditional leverage in the 30 to 55% range, that's where you see most of the most DSTs that come with financing. And these are always going to be projecting kind of an immediate cash flow to investors as well. So going kind of back to our example, hopscotching back a little bit. So that $1 million sale, if an investor contributes the $500,000 of cash that they've generated into this example DST, this Texas multifamily DST that carries a 50% loan to value, their $500,000 of cash contributed to this DST is positioning them to assume $500,000 of loan proceeds, which positions their total projected purchase at $1 million, right? So another way to think about this is the equity is the down payment, right? And if the loan to value is 50%, the debt is 50% of the value of the investment, which means the equity is 50%, right? So the equity coming in, that's the down payment. So it's a 50% down payment in this example of 500,000, which is, positioning the investor to assume the 500,000 of loan proceeds and a total purchase of $1 million. So going back to this same example, and kind of running a different scenario altogether. So the property sold for $1 million. It's a $500,000 loan that's paid off at closing. The investor has $500,000 sent to their qualified intermediary. And here they decide rather than investing into a DST or that carries debt or another property, they decide to pull $500,000 of cash out of their pocket and add it to the 500,000 of cash that's generated from the sale and buy something free and clear for $1 million. This completely works in the context of a 1031 exchange. Remember the two requirements: spend all the cash and purchase equal or greater value. The IRS does not care if you replace debt for debt. What they care about is that you spend all the cash and you replace value for value, right? So we do have investors, let's say they decide they don't want to risk, they don't want to take on the risk of debt, and they have the cash available and it makes sense for them to come out of pocket. This is something that is entirely possible. So talking about the debt-free properties just for a minute, and then we'll get to an example of what this could look like. These are properties that are 100% owned by investor equity, right? There is zero financing element, whatsoever. And the reason why investors are drawn to this is because there's no risk that comes along with debt, right? There's no refinancing risk, no cash flow sweep risk. There's no risk of taking on equal or greater debt in future exchanges. There's no balloon mortgage maturity event that's coming, when the debt matures. There's no cross-collateralization loan risk. And really, I think your biggest advantage is flexibility, right? Flexibility to hold through potential market downturns, credit crunches, recessions, depressions, and really it positions the investors to protect from complete loss of principal due to lender foreclosure, right? That's the main safety is that flexibility and resiliency that you have with staying debt free. I would say in our experience, I would say about half of investors that we work with, about half of them are approaching the 1031 exchange completely debt free. They don't have any, debt that they'll need to consider. The other 50% do have a debt replacement need. So the actual situation varies, but this is something certainly that an investor can consider. So looking at it in the context of a DST. So remember, $500,000 of 1031 exchange equity. Here, instead of contributing to a leveraged DST, $500,000 in this example is going to a debt-free industrial DST with 0% financing. It's all cash. So 500,000 of committed equity is going to lead to a total purchase of 500, right? Then the investor adds 500,000 of cash to this debt-free multifamily DST, and they buy 500,000 worth of real estate value. So if you add those two together, you have $1 million. Going back to the 1031 exchange requirement, the investors spent all their money, all their cash, and they've purchased equal or greater value, right? So they've checked all the boxes from a 1031 exchange, from the 1031 exchange requirement. Okay, scenario three. So let's say you sell a property, you have an $850,000 loan on it. So the investor must reinvest 150 of equity, right, from the sale. And they must apply for a new loan or qualify for a new loan to replace the balance of 850 and purchase something that's worth $1 million or more. So this is where the zero coupon DSTs would come into play. So remember, these are the highly leveraged DST properties that are typically in the 70 to 90% range from a loan to value. The reason why there's zero coupon is because the way these deals are set up is they don't actually pay a cash flow. So 100% of the revenue that's generated from the rents goes to service the interest and also pay down the principal on the loan. So hence the name, zero coupon. And the benefit with the zero coupon is it allows investors to replace a large amount of debt with a relatively small amount of equity, right? So this can be valuable in the scenario we just walked through, with only 15% equity coming out of the sale. Or if an investor wants to allocate a smaller amount of their total 1031 equity to replace a larger amount of debt. We'll go through both examples in just a minute, but we have access to these types of zero coupon DSTs. I talked about the fact that these are not cash flowing to investors. So typically what you see here is you'll have a large, industrial property, let's just say, and it's leased to a prominent tenant, a creditworthy tenant like an Amazon or a FedEx, and Amazon or FedEx assigned a 15-year absolute triple net lease. And so what'll happen is, these sponsor companies, they acquire that property, they get a loan for 70 to 90% of the value. and they'll structure the loan to be coterminous with the lease, right? So over the remaining lease term, the revenue that FedEx or Amazon in this example is paying is going to service the debt. And with the goal of the investor being able to exit the DST from a sale at a more workable loan to value, at a reduced loan to value because principal pay down has been realized over a longer period of time. So using this example, 150,000 of equity contributed to a zero coupon DST at an 85% loan to value, allows that investor to assume $850,000 worth of loan proceeds and get to a total purchase of $1 million. Right. So once again, think of the cash value as the inverse of loan to value or loan to offering. So if it's an 85%, loan to value, the value of the loan is 85% of that investor's total purchase price, and 100% minus the loan to offering percentage. That is the proportional percentage of the equity, right? So here it's 15%. That's another way to look at it if there's any confusion that's still had. So here's another example of an investor that, let's just say they have a $200,000 loan amount that they need to replace. They generate $800,000 of equity from the sale, and they need to purchase $1 million or more. So this is a way of how an investor can allocate a majority of their equity to debt-free DSTs and allocate a very small amount to a zero coupon DST to check the box, for debt replacement, and still position the entire portfolio at $1 million, right? So here, there's 250,000 of equity allocated three ways, the three debt-free DSTs. Combine the value there is 750,000, right? Because there's no debt. The zero coupon, if the investor allocates $50,000, and it's an 80% loan to value, that produces a $200,000 loan amount for a $250,000 total purchase, right? So you see here, the investors selectively identifying a very small amount of their equity, 50,000, and they're placing that into the zero coupon or allocating that into the zero coupon to completely replace the debt. And then that's freeing them up to allocate the majority of their equity, 750 out of 800, to all cash DSTs. So this is another strategy that investors can take advantage of by incorporating a zero coupon. So that actually concludes kind of the discussion and conversation today. I know Alexandra's going to come back on here in a minute and facilitate some Q&A. But for those of you who have not ever corresponded with us at K Properties, feel free to book a call with us. You can go to our website, kpi1031.com, or you can call our main line there at 855-899-4597. But really appreciate everyone's time once again. We hope you found this conversation helpful. Once again, this is free access to marketplace DSTs, live menu of debt-free zero coupon and leverage offerings. We do have other kind of opportunistic and income-oriented real estate funds, qualified opportunity zone funds, all of that you can find directly on the website. And the last thing I'll say before we turn it over to some Q&A is we have some phenomenal educational resources. All of this is completely free. So we'd love to send you a free book on the DST structure, free subscription to our 1031 DST digest, get you access to our weekly conference calls and webinars and other educational events that we host kind of in and around the LA area and all across the country. So For all this, just go to our website, kpi1031.com. And once again, we really appreciate everyone's time today.
Great. Thank you so much for all of that information, Matt. I just put up a poll question for you all. If you do want a complimentary consultation with Matt or someone from his team to learn if this is a good strategy for you specifically, go ahead and say yes, and I'll send them your email so they can coordinate that after the webinar. And again, you can also just reach out to them directly through any of the methods that you see there on the screen as well. So let's dive into Q&A because we already have about 9 questions or so. The first question is, who purchases the rental real estate for the DST?
So the real estate is initially acquired by the sponsor company. So the sponsor company, think of them as the asset manager, right? They're the group. They'll identify a piece of property, they'll run it through their due diligence, they'll front the capital to initially close on the asset. And they do that specifically to make the transactional experience that much easier for the investor, right? They're closing on the real estate to eliminate and strip out closing risk. So what is effectively happening when a DST investor contributes their cash to buy their piece of the real estate is they're effectively buying that piece of the DST back from the DST sponsor company, right? That fronted the capital to close on the real estate in advance.
Got it. Okay. Diane is asking, do net proceeds deduct a realtor fee and or capital improvements and repairs to sell the property?
Yeah, this is a better question for a CPA, but typically any sales related expense. So think of like, escrow fees, broker fees. Those can typically be deducted from the gross sales price and get you to the net sales price. There are other aspects like reimbursements of rent or property taxes or other elements like that that'll show up on a closing statement as well. Those specific elements are definitely something that an investor should connect with their CPA on just to make sure that they're looking at the correct net sales price value and considering the correct value for the 1031 exchange.
Yes, absolutely. It's a team effort, right? So you want to talk
Right.
to a CPA, the K Properties team, a qualified intermediary, probably at some point. So the other part here that was a little, I think, confusing. So if you sell for 1 million, pays off the loan for 200,000, the 1031 has to be 1 million plus or the 800,000.
It has to match the sales price. So in our
I
example, it'd
see.
be 1 million. Yeah,
Got
the
it.
800 was just the equity or the cash value. So the cash has to be fully invested, but the total value of what was sold needs to be replaced or exceeded, right? You can buy more than 1 million, but at minimum, you have to buy 1 million.
Yeah, the whole point, I think, of a 1031 is to encourage further investment into
Correct.
real estate. Stefania, so if I have to reinvest $150,000, but my net is 100,000 and I don't have the extra 50,000, how does that play out?
Yeah, so in that example, I think, and I'm just going to interpret the question. So Stefania, if I'm not addressing it, feel free to ask it another way or ask for clarification. But I'm assuming you mean if you sell for, let's say, $150,000, and after any closing related cost, or at the end of the day you have less than that, right? In your example, you say $100,000 of equity. I then from a 1031 exchange perspective, the IRS is concerned with the net sales price figure, right? So I'm assuming that's a pretty big difference there, 150 to 100, but There are some elements of closing costs that typically are allowable for deduction to get you to a net sales price. And then if there's any mortgage that's paid off in between the 150 and the 100 in this example too, then that value would need to be considered for the 1031 exchange. So I hope I'm answering your question. But if not, feel free. I'm happy to help clarify if asked another way.
Yeah, the K team can run the numbers for you if you have a specific situation you're looking at. Stefania also asked, are the DSTs for residential or also commercial?
Yeah, great question. So they're all different types of properties. I would say the residential represents it's the most popular type of asset class that you see in the DST space. There are a lot of commercial, type offerings as well. We'll see a lot of industrial type properties, medical, multi-tenant industrial, some retail. So there's all different, food groups, so to speak, are represented in the DST space. And from our standpoint, we really like to be able to offer a wide selection because each property type has its unique advantages and disadvantages, right? Like residential is really great, and has performed really well for us, and that's where most of our investors have direct experience in. So it can be a little bit easier for an investor to approach like a larger scale multifamily, with the experience that they have. There's a greater comfort level there. But as many of residential is the most expensive, asset class on a pound per pound basis or on a cap rate basis. So usually what that leads to is a little bit of a compressed projected cash flow relative to other, commercial property types. So a big part of our role kind of in the education is not only educating investors on the different asset classes and the specific advantages and disadvantages, but also seeking to understand what the investor is ultimately trying to accomplish. Like I'll just give a specific example. If an investor is primarily focused on stable, predictable income, and that is like the priority, let's just say over and above any type of appreciation potential, then they could be more inclined to approach something like the FedEx, industrial commercial property that's on a 10-year lease that has that corporate guarantee from FedEx. Yeah, maybe there's less upside potential just due to the nature of how the lease is structured, but there's a higher likelihood of consistency with respect to the cash flow experience over that longer period of time. And then the last thing I'll say is the beautiful thing about the DST through diversification, it doesn't have to be a binary, right? So we don't have to go all in on the commercial strategy, the industrial. We don't have to go all in on multifamily. We can build kind of a balanced portfolio of, say, we incorporate some multifamily, but also some commercial and medical and self-storage and retail, and kind of build this hopefully resilient kind of portfolio that responds differently to different segments of the economy and kind of layers in that defensive strategy for the investor to take advantage of all different elements of the real estate environment.
Well said. George is asking, since you're able to get into a DST relatively fast, would you be able to divest from a DST quickly or at all without the asset being sold completely?
It's a really great question. Yeah, so it's very easy to get in. It's a lot more difficult to get out in the sense that these are not liquid securities. They're not listed on any like public exchange, platform. You have to be an accredited investor to even, purchase one of these. So it's possible to sell out early. But it can take time, and there are situations where investors would have to sell at a discount. Now, that being said, the traditional business plan for a DST is for the investor. So when an investor approaches a DST, they really should be committed to the original business plan, right? Which is clearly identified and mapped out and something we would review with investors, going in, but it's typically anywhere from a 5 to 10 year holding period. Over that period of time, the investor experiences a monthly, cash flow. And then at a future point in time, the sponsor company, the DST company, would decide to sell the property, right? That each investor owns a piece of. When they sell the property, that's the primary liquidity event, right? And that really should be in terms of the original approach, how every investor approaches a DST, being committed to seeing that investment all the way through. Now, life happens, extreme circumstances happen, and it is possible if an investor really needs to or really wants to get out, they can get out, but it isn't as easy as getting in. It takes more time. We'd have to find a secondary buyer who's qualified, that's willing to pay the price that the seller is ultimately willing to accept. So a little bit more complicated.
Okay. Patricia says, what safeguards against the holding company from acquiring debt on debt-free properties?
I mean, with every offering, there's a full, private placement memorandum, which is the official offering document. And in that document, it's very, very clearly spelled out, how that specific venture is capitalized. It's literally on the very first page, like the equity and debt. So you know going in if you're assuming debt or not assuming debt. Now, the second part to the question, which I think is what's being asked here, is what's preventing the company from structuring something, free and clear, debt free, and then, refinancing or getting a loan, later on. And that's actually not possible in the DST structure. So it actually goes against the structural integrity requirements that the IRS has opposed in the revenue ruling. So the IRS put a revenue ruling out in 2004, right? And that's when they firmly established the DST entity or structure to be a 1031 exchange eligible structure. And there are very stringent limitations that are imposed on the DST. It's a pretty rigid structure, which is what the IRS likes, right? They want to know that there are operating limitations, and one of those is the inability to refinance. So for any property, an investor, when they approach it, they're going in knowing that whatever amount of debt I'm taking on is going to be the same debt structure that is maintained throughout the entirety of the investment, or if there's no debt whatsoever, it's going to remain a no debt offering because of that structural requirement.
That's good. Okay. Question from Thomas. Is the zero coupon debt paid off over the term of the DST? And what is an exit plan typically on a zero coupon DST?
Great question. So it's not entirely paid off in terms of the way that I've seen most of them structured. Typically, there's a fair amount of projected pay down of the principal balance. So, for example, if you start at an 85% loan to value, and let's just say it's a 15-year loan, it's amortizing, on a 30-year schedule or whatever the schedule is. Then if, 15 years down the line, they go to sell the property, they're projecting to exit at a 50% loan to value, right? Or 45%, right? So it kind of puts the investor back in puts them back into the ability to exchange into a more traditional, like leverage DST at 45 to 55%, where they can kind of step back into a cash flowing experience. So that's really the goal. And typically, I mentioned this earlier in in the discussion, but the way that a lot of these zero coupon deals are structured is they have a certain lease term and they have a loan term that is coterminous, right? They're coterminous with one another. So if you have a 15-year lease with, FedEx, typically you'll have a 15-year loan, right? That matures at the end of the 15 years. And so the goal is to just kind of hold the property for the majority of the remainder of the lease term, service the debt, pay down principal, and then go back to FedEx, get them to extend their lease term out. And then you can position that property for sale back in the market with an enhanced lease term, right, in the future. So that would typically be the strategy. Now, there's certainly, risk to that, right? We don't know what the future market's going to look like. We don't know 100% if FedEx is going to renew or extend, right? So there are elements of risk that come with the zero coupon and any DST that are really important for us to discuss, prior to considering that. But that's just a very high level, typically what you're looking at for most of the zero coupons.
Mm. Matt, we're at the hour mark. Are you okay with staying a little longer to answer questions, or do you have a hard stop at any point?
No, I'm good for a few more minutes.
Okay, great. Helen says, what happens if there isn't enough rent in the case of apartment buildings to pay for all the incidentals, interest, tax, insurance? Not only do we not get anything from our investment, but would we be responsible for the shortfall?
Great question. So the invest at the end of the day, like this is a real estate investment, right? You own a fractional interest in a piece of property, and your experience from an investment perspective directly correlates to how that property performs. So in a situation where the rental income is insufficient to cover, property taxes, insurance, maintenance, like your operating costs and debt service, then that would be a very, that'd obviously be a very difficult place for that investment to be in. But that's where the DST company would turn to reserves. So there's reserves that are capitalized up, into each of these offerings that can be drawn from over the business plan, over the holding period of the DST. There's actually no capital call that's permitted. That's another structural limitation of the DST. So the investors, approaching a DST know that not only is there not going to be a refinance, but they're not going to be asked for any more money. There's no capital call permitted. That can be a really good thing, right? From the sense of knowing what to expect going forward. It's also limiting, right? Because the sponsor can't access capital through a refinance or through a capital call, right? So you can look at it both ways. That it's just the way it is. I will say, it would be a pretty extreme situation for one of these multifamily properties to not be at a place of being able to, meet debt service and their operating expense. If you recall, typically these deals are, 35 to 55% loan to value. So a lot of these deals have, debt service coverage ratios, which we don't have to, get far into that, but they have debt service coverage ratios at a minimum of like 1.6 to 2 or 2 plus. So what that effectively means is you would have to see a very, very, very substantial reduction in your occupancy or your rental rate to be even at a place where you're not able to cover both operating expenses and, debt structure or your debt service. So we've never seen that take place specifically like with the apartments. Not to say it's not possible. I mean, anything's possible, under the sun, but that's where diversification is going to be really big, and that's where those pre-capitalized reserves are going to be important to get you through, some of those tough times.
Yeah, good clarification on that. But very straightforward and realistic, I think. Patricia and Diane had both asked, if you die, do your heirs get a step up in basis?
They would, yeah. The DST interest is treated the same way as any other type of real estate asset. So
Beautiful.
yes.
Do you get a depreciation write-off with the DST?
It depends on the investor's basis, because that's going to carry forward with them, into the DST. But generally speaking, yes. So at the end of the year, the investor will get a full tax package. The sponsor will break out the land and building value associated to their interest in the deal. And then the CPA would be able to calculate the depreciation expense to cover, taxable income. So yeah, most investors unless they have zero basis, they are taking advantage of depreciation. And last thing I'll say is this goes on Schedule E of the tax return, so it's accounted for the exact same way of any other rental property.
Paul and Patricia had similar questions. What are the typical returns attributed to appreciation? And also, what's the return on the amount invested in the DST?
Yeah, there's a wide range. I mean, we've been fortunate in that DSTs have done fairly well over the last, 50, especially the last most of the last 15 years. We've been in, a historic run up of real estate value. So the DSTs have taken advantage of that. I think the general expectation with respect to a DST investment is to be in a position of, protection of principal, right? That's always like primary, kind of primary paramount to everything. Second is like a durable, predictable income. Cash flows vary based on market cycle, but to give like a wide range, anywhere from like 4% to like 6, 7%, depending on the deal and the risk factors is typically, the range. And that's a projected return on the cash invested immediately, for the first year. And then, the hope is beyond that to realize some modest, equity appreciation. So if you're in the anywhere from like a 2 to 4 or 5% a year appreciation, like that would be considered a win, for a DST. So these to provide a little bit further context, like the DSTs, these are typically stabilized Class A assets, right? You're buying the new apartment property in Dallas that's fully leased up. You're buying the brand new, Amazon distribution facility, right? So these properties are oriented for an investor that's maybe more inclined towards consistency and preservation than like drastic growth or upside, right? This is not a fix and flip strategy. It's not a heavy value add. It's not a quick in and out. It's a buy and hold cash flow sell, 5 to 10 year hold, typically specifically oriented to a mailbox money type of an investor.
Yeah. And that goes along with the question Patricia and Elizabeth had. So how does an investor experience that income from the DST, and what is the typical cash flow?
Yeah, so it's a monthly distribution for yeah, for all DSTs it's paid monthly. And like I said, it's right now you're in kind of the 4 to 6% range
Mhm.
as a kind of an expected immediate like year one distribution on the invested equity. So that's kind of what you're looking at.
Mm. Yeah. And Chris was asking, so what if you invest in a DST with a 6% return? Can this 6% return be reduced after investment?
Yeah, absolutely. So at the end of the day, there's no guarantees with any of these investments, like the 4 to 6% or whatever the projected return is. That is purely a function of how the property performs,
Mhm.
right? Which is what are they bringing in rents, less all the operating expenses, right? Different property types have, are more involved, from that perspective than others. But what is that net, operating income, as compared to the total value of the investment, right? That is really the basis through the projected distributions. And, this is where, some of the nuance creeps in with respect to the asset class, right? So you would expect something that is, more operationally intensive, say like a large scale multifamily or self-storage or like a hotel type, offering. Um, for it to be a little bit more difficult, to be exactly dead on the number, like what you can expect in terms of a distribution. And for that to be like completely consistent over like a 10-year stretch of time. That being said, all these companies, like what they're trying to do is kind of under promise, over deliver. So they have a certain baseline that they're projecting that they're confident showing to investors, because the last thing they want to do is have to, is to fall short of what they're projecting. But it does happen, right? And so that's another part of going back to the diversification strategy of we really don't want investors to over concentrate into any one investment. However attractive it looks or however, amazing it looks, like you never know, right? There's events that are completely out of our control. There's operating expenses that are completely out of our control, and those can have a direct impact on, what these investments are able to produce. I mean, case in point, like look at what insurance rates what's happened to the insurance markets over the last couple of years, right? Like anyone who's on real estate anywhere has had massive increases in their insurance premiums. If you were putting a deal together 7 years ago, like could you have accounted for your insurance premium tripling, in one year? Like, so there's certain elements like that are completely out of our control. And I think it's through kind of the conservative, diligent underwriting combined with like diversification and taking advantage of different property types and asset classes, sponsors that really builds that resiliency from an investor standpoint.
Definitely. Elizabeth and Michelle have similar questions about when the DST expires or ends after those 5 or 10 years that you mentioned. What are the requirements for the investor at that point? Do they need to start all over and invest in a whole new DST or portfolio of DSTs? If they had only residential DSTs, can they do industrial DSTs now?
Great question. Yeah. So with any 1031 exchange, there's no limit to the type of property you can invest in. So the IRS only cares that you're investing in another like kind property, which is just any investment used for business or investment purposes. You can do apartments to industrial, industrial to apartments, residential to raw land, right? Anything, any type of property, qualifies. With respect to when a DST goes full cycle and is sold, the all the 1031 exchange requirements and the 1031 exchange process starts over, right? So the investor would be entitled to their portion of the net proceeds. If there was any debt paid off associated with their ownership in the DST, they would be responsible for replacing their proportionate amount of the debt that was retired at closing, and they would be free to purchase another DST of any property type or purchase another hands-on piece of property more in a traditional sense, right? That they self-manage. So the whole process would repeat itself.
Okay. There's still some questions. I know it's been a little over our 60-minute mark here. Do you want me to send these to you offline, Matt, or would you prefer to answer them right now?
Yeah, why don't we take maybe one more question now? And then, like I said, if anyone has more questions, I know there's a lot of nuance to all this. There's a lot. That's exactly what we're here for. So if you reach out to us, we will have someone get back to you and get you all the information that you need. But yeah, why don't we take maybe just one more for
Okay.
now?
How about this one? So if the loan defaults in the DST, do you have to pay taxes on the cancellation of debt?
Yeah, so if the loan defaults on a DST or any, real estate investment, let's just say like a foreclosure event, right, is what we're talking about here, where an investor owns an investment property, the property gets foreclosed on. How the IRS views that is they actually view that as a sale, right? So it's a sale at the outstanding balance of the loan amounts at that point in time, right? So if the DST or if the investor had a property and let's just say, there was a 50% loan to value, they bought it, for $1 million. There was a foreclosure event, right? The sale here would be marked at $500,000 from the IRS's perspective. Now, here's where the nuance creeps in, and this is where it's really more of a CPA question, but I'll answer it at a high level, is it really depends on the basis, right? So when the IRS is looking at any sale of an appreciated asset, your capital gain is the difference between your basis, right? The value that you've depreciated that investment to over the years and what your paper value is versus the sales price. So there could be a situation where an investor has, say, a $600,000 basis, right? And there's this foreclosure event. And in that situation, it would be actually a loss for them. Like there would be no capital gain. But if they were, let's say they had $200,000 worth of basis, then you'd have a $300,000 capital gain, right? So it just depends what the investor's basis is and also the value of the outstanding loan balance at that time. And then, of course, the investors, if it's a DST, like their proportional, attributed value to that loan based on their ownership.
Great. Well, speaking of CPAs, we are having a CPA come on and speak to all of you next week. So they can get into some of that and also tax deductions and other tax strategies, not just the 1031 here. Cost segregation is definitely part of that. The big, beautiful bill, lots of updates there. So I hope you all will join next week as well. Matt, this was fantastic. Thank you so much for staying a little longer and answering so many questions. We're going to email everyone the recording tomorrow with the slides, Matt and the K Properties team's information. And if you'd said that you wanted a complimentary consultation, someone from the K Properties team will be reaching out soon. You can expect my email in the next day or so. And the invite to the next webinar will be in that email as well. So Matt, thank you so much again for staying, and we appreciate you. Hope to have you back soon.
Absolutely, Alexandra. Thanks for having me, and thank you to everyone who took time out of their day. We really appreciate it.
Yeah. Take care, everyone. Bye.
All right, bye-bye.